Retained earnings started at one number and ended somewhere completely different. So what changed? Let's solve it through a Schedule M2 case study. We begin with a question. Beginning balance is 2 million. Ending balance is 4.6 million. So how did the balance change during the year? What happened in between? This is exactly why Schedule M2 exists. It explains movement in retained earnings, beginning balance, income, distributions, and ending balance. For learning purposes, we're using simplified hypothetical balances. These assumptions help us focus on understanding the mechanics of Schedule M2. Before preparing Schedule M2, we gather beginning balances, current year income, and distribution information. These become our inputs. Schedule M2 follows a simple 4-step framework. Beginning balance, add income, less distributions, and compute the ending balance. We begin with our starting point, a beginning balance of 2 million. Can we explain every movement from here? Current year ordinary income increases retained earnings, so our balance grows as the business earns income. Next come distributions. Cash distributions reduce accumulated balances, so this amount moves the balance downward. Now let's compute the ending balance. Beginning balance plus income, less distributions, results in 4.6 million. Can we now explain every movement? Here's the completed Schedule M2 format. Notice how every movement now reconciles from beginning to ending balance. Understanding the mechanics is important, but avoiding common mistakes matters too. Let's quickly recap. M2 tracks retained earnings movement, and ending balances should always reconcile. This case study uses simplified assumptions and hypothetical scenarios for educational purposes. Thank you for watching. If you found this helpful, subscribe for more structured U.S. corporate tax case studies and practical tax return walkthroughs.